Hey, well, home prices are completely nuts, right? We know that they're out of control. In fact, over the last 4 years, home prices have increased over 40% nationally. And despite what a lot of folks wanted, wished for, and hoped for with higher interest rates, those prices have not come down substantially. And nationally, we're actually up 4.5% according to Redfin as of last week. So this year we're up 4.5% already. And over the last 4 years, over 40% increase in home values. Americans right now have a ton of equity, actually upwards of $16 trillion in equity nationally. I mean, it's just crazy, right? So why have home prices continued to be sticky in the face of higher interest rates? Well, according to the Federal Reserve, Jerome Powell, it's because we haven't built enough supply. That's right. Even the Fed is coming out and saying, hey, folks, it's about supply and demand, basic economics. And right now, our supply isn't meeting the demand. And so, because of that, prices are sticky. He also went on to say it's not his responsibility or the Fed's responsibility to keep home prices in check. Yeah, he said that. So, that's what we're going to look at today is his speech and a map of the United States and where inventory has shifted from 2019 through 2023. My name is Jason Ferrier. Thank you for joining me on this Saturday morning. I appreciate it. I hope you enjoyed today's video. All right, let's get started. So the name of this article, this is from Resiclub Analytics. The name of this article is Blame for High Home Prices. Fed Chair Powell says there hasn't been enough supply built. Powell says the Fed isn't directly targeting home prices. And a lot of folks I hear on YouTube have said, hey, once the Fed does their job, once they do what they're supposed to do, then housing prices are going to come down, not like 2, 5, or 10%, but they're going to come down to the point that it's like a fire sale. Like I can buy a house for pennies on the dollar, just like in 2012. Hasn't happened. Let's go into this article. All right. Speaking to reporters on Wednesday, Fed Chair Jerome Powell said that while the central bank is pleased with the progress on the inflation front, committee members aren't quite ready to start the rate cutting cycle. Powell mentioned that if the job market weakens faster than expected, they're likely to cut rates sooner. On the other hand, if inflation proves stickier, they will wait longer, he added. Notice he doesn't say we are going to maybe raise rates if inflation proves stickier. He's saying we're either going to cut or we're going to stay put. We're not going to raise. Completely different narrative than it was over the last few months. During the presser, Nancy Marshall with Marketplace asked Powell, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected. And I think when she said you, she meant a lot of the American public. You know, a lot of the pundits out there and Crash Brothers thought, yeah, prices are going to crash. I guess she's saying they're not crashing. And she's asking the Federal Reserve, Jerome Powell, why do you think that is? This is what he says. Standing at the podium, Powell responded and saying that the Fed isn't directly targeting home prices and insinuated that the fact there hasn't been enough supply built is the real culprit for elevated home prices. Wow. So even the Fed is saying it's supply and demand. Comment below. Love to know what you think of what he has to say. All right, here's Powell's full response. Our statutory goals are maximum employment and price stability, and that's what we are targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very rate sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built up set of cities and people are moving further and further out. There hasn't been enough housing built and are not things that we have any tools to address. So the Federal Reserve saying we don't even have the tools to address the housing market if we want to. But let's take a second and think about this. Commercial real estate is completely different. And I would argue that he has done a great job of crushing commercial real estate values. I mean, values are plummeting in commercial real estate, not residential, not single family, or not 1, 2, 3, 4 unit buildings. We're talking 5+ buildings in commercial and office buildings. Because he's raised the benchmark rate so much, and I know I'm an investor, I can tell you he's raised these rates to the point that if you have to refi and you own a commercial building, like an apartment building, you got to refi that debt, man, right now is a bad time to refi it because what you probably bought at maybe 4 or 5%. Now you're facing 7, 8, 9% rates. And your cash flow is going to be seriously impacted because that cash flow is impacted. That hurts the value of the building. It hurts the actual cap rate. So because of that, they're going to people are going to try to raise rents, raise tenant rents, but the Fed has done a great job at targeting commercial real estate prices, I would argue, not residential, much to people's chagrin. Where housing comes into play very specifically in our work is inflation, which is really rental inflation. You're taking owner equivalent rents and then actual rent paid by tenants and running it through the CPI calculation or PCI calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat. And that will show up in inflation over time. So he's saying the owner equivalent rents, meaning how much you can rent your house for if you own a house, how they measure this, the rental prices, and if rents increasing nationally or not, is that they look at owner equivalent rents, how much you could rent your house for if you own a house. And then they say, hey, is that coming up or down? Well, according to him, it's not increasing as much. So that's why he's saying they're controlling inflation on that end. But regarding actual home prices, he's like, hey, I don't have the tools to address that. And this is important to know. Most, like 90% of people with mortgages for their house they live in have fixed rate mortgages. And those mortgages are a lot of times under, for most people right now, under 5%, 4%, some even under 3%. And because of that, if he raises the benchmark rate, it doesn't do anything to those people. They are not hurt at all. To them, they're like, well, my house payment's the same. Taxes could go up, sure. Insurance can go up, but that can happen in any environment. But regarding the payment on the mortgage and interest, not changing. So a lot of people are like, you can raise rates all you want, man, but I got my payment and I'm good. And that's why people aren't moving, putting their houses on the market, keeping inventory tight, and hence supply tight and prices sticky or having a chance to increase like they are this year already. Through the course of the rate hiking cycle, Powell's perspective on where he thought home prices would head has been, well, hard to nail down. And they go on to talk about, I'm not going to read all this, but they go on to talk about the different spots and when Powell addressed the housing market. And I really don't care about those, honestly, personally, but you can read them. And I just think it's amazing, though, that now he's coming out and finally saying, hey, supply stinks, folks, and we need more supply, and that'll help prices. Supply, demand, economics 101. And then part of this article talks about the Case-Shiller home price index and how it's gone up. Nationally, single-family home prices as measured by Case-Shiller are up 5.1% on a year-over-year basis and up 6.6% since hitting the bottom in January of 2023. In 2022, home prices spiked, right? This is according to the Case-Shiller National Home Price Index. And then they dropped, right? I mean, if you look at this, 12-month shift in home prices went all the way down, actually to zero. And then now it's back up to 5%. So the shift, we had a bit of a reprieve in prices, but now they've shot back up. So that's the speech that he gave. Now let's look at inventory across the United States and see, hey, how much has it shifted from 2019 through 2023? Do we, in fact, have less inventory? All right, so this map is awesome. This is on Resiclub Analytics. And you can go to their website. I think you have to pay to look at something like this. Like I said, I think it's like $150 a year. The link's in my description below. Awesome, awesome real estate website, though. Before I show you this map, please like and subscribe to my channel. I post updates all the time about the national housing market. And a lot of times I include information about the local market here in Central Ohio, where I work as a real estate agent and an investor. And if you need to buy, sell, or invest in real estate here in the Buckeye State, give me a shout. Hit me up in my my information's below. I'd love to connect with you and help you out, even if it's just providing some data, giving you my perspective, or pointing you to somebody who can help if I can't. All right, here we go on this map. So this map is fantastic, like I said, and you can basically click around this map and say, hey, where it's county by county, and you can go, where are inventory levels up versus 2019 or down versus 2019? This isn't year over year. This is month over month. This is over the last 4 years. So let's start with where I live, Licking County, Ohio. That's the county, Licking, right? People always make fun of that. 23% down compared to 2019. So in 2019, we had 23% more listings and available houses for sale than we do right now. Franklin County, Ohio, which is Columbus, down 27%. Hamilton County, Ohio, this is just nuts, down 40%. That's where Cincinnati is, down 40% in inventory. All right, let's go all the way across the country here. And let's go to Santa Barbara County, California, down 48%. San Diego County, California, down 44%. Now, the brown is obviously where inventory is suppressed compared to 2019. The green is where it's elevated. Let's look at some green spots. Texas is just taking a beating. Man, Travis, Texas, which is where Austin's located. That's Austin, Texas's county. 42% increase in inventory. Every single week, I review Redfin's data, and almost every single week, Austin is on the list as far as declining prices, not increasing prices, declining prices. And their inventory is up 46% compared to 2019. I mean, that's a completely different story than California and in San Diego, where inventory is down 40%. In Travis, Texas, up 40%. Okay, Harris County, Texas, which is Houston, down 22%. I hear people a lot talk, a lot of people talk about Texas has a lot of people. It's a huge state, has a lot of construction, a lot of building, a lot of new construction. I hear a lot of people say inventory's exploded in Houston. We have way more inventory than we need. According to this, down compared to 2019. So maybe you have more inventory than you did last year, but from the last 4 years, you look back, you have less inventory for sale. Adams County, Colorado, that's Denver, down 8.8% in inventory compared to 2019. All right, let's go to Atlanta. Fulton County, Georgia, which is Atlanta, down 35% in inventory compared to 2019. Not hyper supply, at least according to the data I'm looking at. All right, let's go out to Boise, Idaho, which is Ada County, Idaho. That's Boise, down 20.4% from 2019 through 2023 inventory. Let's go to Miami, Miami-Dade County, down 43%. Just unreal, right? Look at this, Chicago, Cook County, Illinois, down 51% compared to 2019. So again, you look at this map, there are a lot of green spots, no doubt, but there's a lot more brown spots where inventory, and it's almost like grass, right? In your yard, you've got green spots that are lush with tons of inventory, and then brown areas where there's just nothing. So that's the most of the country. I mean, look at the Northeast. Look at the fact that there's just zero inventory. Sussex County, New Jersey, down 72% in inventory. Providence, Rhode Island, down 58%. Prices there, I'm sure, are increasing much more than they are in other areas. And I know that's true because every week I review that Redfin data, and Providence, Rhode Island is on the opposite end of the spectrum from Austin. Austin is always down in prices over the last, year. They always make that year-over-year decline list. But Providence, Rhode Island always makes the year-over-year list where prices are increasing the most. And it's usually double digits. It just comes down to supply and demand, folks. If we increase the amount of people that need or want and are out there looking for houses, for whatever economic reason that is, then prices are going to increase if that supply is not there to meet that demand. Conversely, if demand tanks, which demand's really low right now, actually, I mean, there isn't a whole lot of demand, but the amazing thing is the inventory level's so bad in the United States right now in most areas, that level of demand, that suppressed level of demand is still enough to keep prices elevated. Can you imagine what happens if interest rates drop again? If they drop to the low 5%, the low 4% range, heaven forbid. I mean, prices are going to just explode again. And a lot of these states haven't seen relief yet. Like in my area, we haven't seen relief. And so if interest rates drop for some reason, that's just going to cause more doom for house prices in the reverse way, not down, but up to the point of complete unaffordability, which seems like where we are already. So hey, what do you do with this information if you're a buyer, seller, or investor in real estate? Well, no one can make that decision for you. I mean, at the end of the day, you got to review this data and data in your local market, and you have to make the decision yourself because everybody has a different situation. Everybody, right? So no one can tell you it's the right time to buy, sell, or invest. However, what we've seen over the last 20 years is that home prices on average have gone up 6%. If you look at the Case-Shiller index, on average, you span out the last 20 years, there's been ups and downs, but overall, average it all out, I calculated it came up to 6%. So every year it's gone up 6%. Now, does that mean it's always going to go up? Well, heck no. Does that mean it couldn't go down? No, it could definitely go down. But in real estate overall, in the history of the United States, has been a great investment. And it still is a great investment. And I'm not a financial advisor. I'm just a real estate agent. I'm an investor myself. So I have my own money in real estate right now. And quite frankly, I don't care if home prices increase or decrease. It doesn't bother me at all. I don't care either way. But I am saying that real estate has treated me very well. And I think it's, in my opinion, it's a good investment. However, no one can tell you if it's right for you except you. And so that carries over to selling. Is it the right time to sell your real estate given this market? Prices are still elevated. They're continuing to go up. Is now the right time to sell? Well, personally, me, I say don't sell your real estate. I say hang on to it. Selling real estate, if you need to, you have to because of whatever situation, fine. But if you don't have to sell your real estate, don't sell it. And don't let anyone tell you that it's hard or it's impossible or it's a complete catastrophe to rent out your property. A lot of people right now, because of rental prices, when they move out of their primary residence, they're keeping it as a rental and then going on to the next place, but hanging on to that primary residence, the first one, as a rental. And that's a great strategy. There's nothing wrong with that. If it cash flows, heck, even if you're breaking even on that property and you can afford to buy the next one, that's something to consider. I mean, having a rental property or rental portfolio can do wonders for you, not only in the short and midterm, but as you go on in life in the long term, it can really help you. And if you decide to pass that stuff down to your kids or other generations, there are massive benefits with that, not only with taxes, but with just generational wealth. And I would encourage you to investigate those. And we'll do more of that on this channel as time goes on. But for right now, I would look at this information if you're a buyer, seller, investor and say, all right, where is my county? What's happening with inventory right now in the price points I'm looking at? And then make that decision yourself. Get with somebody who can provide you very local data down to the county, the zip code, even the neighborhood level to make those decisions. And if you're an investor in real estate, welcome to my channel. Thanks for joining me. We're going to talk about more investing as we go on. So anyway, comment below. I'd love to know if you're an investor or if you rent out a home, a second home or something like that. I'd love to get your opinion on it. And then take a look at this article from Resiclub because Jerome Powell's comments are just off the hook. They're just crazy. Okay, so thanks for joining me today. I appreciate your attention. Have a good day. We'll see you on the next video.